If you locked in a mortgage rate in the last couple of years, you've probably felt that payment right in your gut. Interest rates have been high, your payments have been high. I've been in mortgages for over 23 years. I'm located right here in downtown Woodstock, and today we're going to break down how to refinance smart in 2025 and how to avoid the traps that waste time and ultimately money. I'm going to try to break it down as plainly as simple, real numbers, actionable steps you can use today. Lower rates are finally cracking the door open, and windows like this typically don't stay open long. So what's happening now and why it matters? After a brutal run of rate hikes, we're finally seeing real signs of relief. Inflation has cooled off. The market's pricing in easier policy. Borrowing is getting cheaper than it was in 2023. If your current rate starts with a 6, 7, 8, or 9, this is your shot to create some breathing room. Lower rate, lower payment, both. Plus, for investors, better cash flow that you can turn a shaky rental into a winner. But again, the windows do not stay open long. They close, rates move daily, speed matters, and preparation matters even more. Here's the game plan by scenario, and then we'll hit some pitfalls, myths, escrow, and step-by-step actions you can follow right along with this video. When a refinance actually makes sense, rule number 1, do the math before you fall in love with the idea. Here's how I would frame this with any client. Can you drop your rate by about 1% or more? It can be less, but you still need to be able to recoup the cost within 24 to 36 months. That's the ideal situation. Obviously, lower better. Are you going from a fix to an arm or an arm to a fix? Obviously, we want to go to a fixed if we can. Remove mortgage insurance or change the term to lower the amount of years you have left on your mortgage. For example, you owe $300,000 at 7% and you drop it to 6%. The move can save you roughly around $200 a month in interest, and it compounds over time. If closing costs are $4,800 and you save $200 a month, that break even is 24 months. That's a pretty solid win. If you want cash flow today, you can also reset the term back to a 30-year term. Payment goes down more, total interest over the life goes up. So you choose based on your goals. If you want speed, shorten to a 20 or 15 years and watch that interest rate bill get cut to pieces. Conventional loans is probably the workhorse of all the different options. If you have a conventional loan or have enough equity to switch into one from an FHA, here's how to think about it. Why is this good? You've got flexibility. There's no upfront mortgage insurance fee. If you're already at or below 80% loan to value, you can get rid of that private mortgage insurance. With strong credit, pricing is sharp and you can lock in a clean fixed rate. Here's what you want to watch out for on a conventional. Likely, you're going to need an appraisal. If values dipped in your area, your equity may be thin, and that can limit your options. You need credit and income to qualify. Think 620 minimum, but the best pricing shows up north of 740. And yes, closing costs are real. You can pay them out of your pocket, you can roll them into the equity if there's enough equity available, or use a lender credit in exchange for a higher interest rate. Who wins here? Folks with good credit, steady income, and 20% equity who can strip PMI and rate at the same time. That combo can move a payment by hundreds of dollars a month. Here's a scenario that we worked on for a borrower out in Canton. Bought with 5% down in 2022 at 6.87%. PMI, values climb, she paid down the principal, and now she's at 80% LTV today. We refinanced her into a 30-year fixed, lower payment, removed the MI, payment dropped by $300. She kept her cash reserves intact by using a moderate lender credit. It's a win for everybody, and she still has flexibility if interest rates come down even further in the future. If you're FHA and you go from FHA to FHA, this is the Streamline shortcut. If you currently have an FHA loan, this one is built for speed and simplicity. It's good because there's no appraisal in most cases, often no income documents, very light credit review. It's designed to lower your monthly payment fast with very little cost. Here are the rules in just plain English. You need to have a current FHA loan. You need a benefit like a lower interest rate or a lower combined payment. You need at least 6 payments made and roughly 7 months since the last closing took place, either from purchase or a refinance. Payment history needs to be clean. What people forget, FHA mortgage insurance sticks around. It does not go away with a refinance unless you go to a conventional. There's upfront mortgage insurance premium on the new loan, and that's usually financed. If your equity is strong, compare this to switching into a conventional loan and ditching the mortgage insurance altogether. Sometimes the easy button is right, and sometimes the smarter long-term play is to graduate out of an FHA loan. My buddy Zach bought a house last year with 3.5% down at 6.5% on an FHA loan. We streamlined down to a 5.5%, no appraisal, payment drops. He accepts the new upfront premium because the monthly savings win is month one. Later, once equity is there, he can refinance into a conventional and remove the insurance. So it's a two-step plan. It's simple and it's effective. There's no guarantee, of course, there never is, but there is a high probability that interest rates will continue to trend down and he can take advantage of it. VA to VA, the interest rate reduction refinance loan that veterans deserve and active military deserve. Anybody who has a VA loan can take advantage of an interest rate reduction refinance or an IRRRL, and it's the smoothest path that's out there. It's good because there's no appraisal, there's no income documentation, there's no mortgage insurance, closing costs, and the funding fee can be added to the new loan amount. So no out-of-pocket expenses. It can be literally down to zero. There are some recoup requirements. What you need to know, you need a clear benefit like a lower rate or moving from an ARM to a fixed. There's a seasoning period similar to FHA. Most lenders want a clean mortgage history. You're going to need that to get the best pricing. There's a simple recoup test which determines if it makes sense or not. Here's a unique perk. You do not need to live in the home today as long as you did live in the home before as a primary residence. So if you moved and kept the place as a rental, you can still streamline that loan even though you don't occupy that property anymore. We recently worked with an Army vet here in Woodstock, Georgia, had 7% VA from a couple years ago. We just did an IRRRL into the low fives. No appraisal, no pay stubs, closed in 15 days. That's how the program was supposed to work. He's saving money on a monthly basis. He's getting an opportunity to lower that interest rate and get the immediate savings. USDA to USDA, the rural refinance that flies under the radar. If you're currently in a loan that's a USDA loan, the Streamline or Streamline Assist can be a lifesaver. Why is this good? Just like the other Streamlines, there's no appraisal needed. A Streamline Assist can skip credit and income checks altogether. You can fold allowable fees into the new balance in most cases. You must save at least $50 a month. So by design, it absolutely approves affordability. Now, there are some limitations to remember. Primary residences only. You still have the annual USDA fee. There are income rules for eligibility as far as household income, and you need that on-time payment history. For our investors and non-QM folks, smarter ways to fix that expensive interest rate that you took out over the last couple of years. This is where a lot of money gets left on the table. Let's say you used a DSCR or a bank statement loan in the last couple of years, or really any non-QM product during the high interest rate years. Odds are your rate is 1% to 3% higher than the actual conventional interest rate. That spread kills your cash flow. So here's a couple paths to consider. If your tax returns now support it, graduate into a full doc conventional investment loan. It's going to be a lot cheaper money, and it's certainly going to be better terms. If not, shop the QM market again. Rates and programs have absolutely approved, and you can often move from a short arm to a fixed or add an interest-only period to boost cash flow while rents catch up. Huge caution out there for the non-QM folks. Prepayment penalties have absolutely been added to many of those loans. Many DSCR loans carry 1 to 5 year prepayment penalties. So do not guess. Pull the note, find the clause, and price out the penalty against the savings. Sometimes it's still worth it. Sometimes it's going to be better to just wait a few more months or maybe a few more years. Here's a perfect example. I've got a rental in Ackworth, 8.75. New DSCR pricing is sitting in the low sevens for this particular profile. We modeled 3 options. Refinance with a 1-point prepayment penalty. It still nets $225 a month in savings. Wait 6 months. The penalty drops about half. Saving goes to $300. A full doc Fannie Mae loan at a lower interest rate if the borrower has cleaned up his DTI and gotten the reserves in line. We picked option number 2, circled the date on the calendar and lined up the docs so we could lock the day the prepayment penalty drops. That's the planning that matters. It doesn't necessarily have to take place today, but if we can put together a plan, a strategy, we'll know when to jump when the iron strikes. Costs, credits, and break even matter. So let's talk about closing costs like grown-ups, because they absolutely do exist. There's no such thing as this no closing cost refinance. It's built into your interest rate. So there are costs. On a full refi, you'll see lender's fees, title fees, appraisal if it's required, recordings, setups for taxes and insurance, intangible taxes, doc stamps. You've got 3 ways to handle this. Number 1, you pay it out of pocket. It keeps your balance lower. It's best if you hold this loan or plan to hold this house for an extremely long time. The option 2 is to roll the costs into the loan. It's easier on your cash. You do pay interest on those dollars, though. You need the equity in the house in order to do it. You can use a lender credit. You take a higher interest rate, and that credit covers some of the closing costs or all of the closing costs. It's great if you plan to refinance again, or do you think the option to refinance again will be there, or if you plan to sell in a couple years. It's also great if you like keeping cash in your pocket. Break even should be your compass. It's the total cost divided by the monthly savings equals months to recover the spend. Under 24 to 36 months is usually a green light. Above that, ask why you're rushing. Sometimes it still makes sense, but just be clear on the trade. Here's a pro tip for the folks that are super detailed. If you roll closing costs into the loan because cash is tight, then when your old escrow refund hits, throw it straight back on the principal. You lower your balance back toward where you would have been and still captured the easy closing. Here's 2 myths that keep biting people. Myth number 1, you skip 2 payments. You don't. You pay interest every single day that you borrow. At closing, the payoff collects interest due to the old lender, and the new lender collects the interest for the rest of the month. You just won't make a normal payment in the very next month because the timing shifted. Treat the skipped payment like a gift to your future self. Set it aside and use it for principal or put it into savings. Myth number 2, closing at the end of the month is always better. Closing at the end of the month means less per diem interest at the table. Closing mid-month means more per diem now, and your first full payment starts later. Across the 2 loans, the interest evens out. Pick the date that works for you and your schedule and your rate lock. That's not a myth. Let's talk a little bit about escrow, refunds, and why year-end refinance can feel expensive. If your current loan escrows taxes and insurance, here's what happens. Your old escrow account closes and the servicer sends you a refund, usually inside of about 2 weeks. Your new lender builds a fresh escrow account, which means at closing, they collect months of taxes and insurance to be ready for the next bills. This is your money, not a fee, but the timing can absolutely make you feel the pinch. Heads up around year end. If property taxes are due soon, that new escrow cushion can be pretty large. I've seen folks bringing several thousands of dollars to closing, then get a similar large refund check, a couple weeks later, maybe even a little extra. But it's not extra. It isn't. It's the same dollars doing a lap. Plan cash accordingly. If you have 20% equity on your conventional loan, you can waive escrows and pay taxes and insurance yourself. Look, a lot of people like that control, and you don't have to finance that escrow account into the new setup. Most stick with escrows for convenience. Either way works. Right now in 2025, credit, DTI, and student loans are a major issue, and this is affecting more people than you think. Scores drive pricing. If your credit dipped, especially from missed student loan payments after the pause ended, you can see a rate bump or even an approval issue. So make certain you're current before you start that application. Use income-driven repayment plans if you have to. If you plan to refinance inside 60 or 90 days, avoid opening any new lines, pay down cards, and fix any errors you find on your report. Debt to income is the other gate. Now that student loans are active again, the real monthly payment counts. If that pushes your DTI too high for conventional, an FHA, or if you're eligible for a VA, may give you more room. Pick the program that fits the math, not just the one that you started with. Do what's best for you, and the math makes sense. Home values and equity reality checks are a thing right now. Not every zip code is absolutely booming. Some markets have dipped. If you're light on equity, choose a plan that fits the facts. Conventional loans above 80%. Loan to value, bring PMI. FHA regular refinances go up to 97.75% with an appraisal. FHA Stream, VA IRRRLs, and USDA Streams can work even when equity is thin because they skip the appraisal. If you're underwater and not in a program that allows a streamline, you might need a two-step plan or some sort of principal paydown before a refinance is even possible, and maybe just pause altogether. If you're close to 80%, sometimes bringing a small amount of cash to hit that mark and avoid PMI is the best return you'll get this year. Run both versions and see which one wins over the next 5 years. Term choice is personal. 30 years maximum cash flow, 20 or 15 crushes the interest bill and builds equity fast. One move I like for higher earners is to refinance to a lower rate on a 30-year term for flexibility, then set up an auto draft that pays like a 25 or 20-year term. You keep the safety net, but you still race the balance down. Now, when it comes to locking your interest rate, chasing the absolute bottom is a trap. You're going to try to time the market, you're going to miss the market. If the math works and the savings are there and it's real, lock it in. If your lender offers a float down or a renegotiation when the market rips lower, great, take advantage of it. If not, remember, you can always take another bite later if rates continue to slide. Do not let perfect kill good. Here's how I would run this if you were sitting in my office. Step number 1, we're going to take a snapshot of your current loan, the balance, the rate, the program, the escrow status, the first payment date. Get your most recent mortgage statement and evaluate it. Step number 2, we're going to pull soft credit and view and list out the debts. We want scores, credit card balance, car loans, student loans, all of it. If anything is late, we need to fix that first. Step number 3, get a quick value check. Talk to a local agent you trust. I can certainly put you in touch with them. Pull 3 fresh online estimates and average them. You just need a ballpark to test the scenarios, and I certainly have some tools in-house to help you with that. Step number 4, pick your finish line. Do you want max cash flow, fastest payoff, or do you just want to remove mortgage insurance? Clarity here decides the product and the term. Step number 5, run 2 or 3 paths. Conventional with or without MI, FHA Streamline versus switching to a conventional, a VA IRRRL if you're eligible, that's usually always going to make sense, a USDA Streamline if that's you. For investors, DSCR versus conventional full doc, lay them side by side with payment, cost, break even, and 5-year totals. Step number 6, decide how you handle closing costs. Pay, roll, or credit. In other words, pay them out of your pocket, roll them in, or take a lender credit. Match it to how long you expect to keep that loan and what your long-term goals are. Step number 7, lock and then execute. Once the numbers hit your target, lock the rate. Upload docs the same day if you haven't already provided them to your lender. If an appraisal is needed, prep the house and your upgrade list. We want to list out any upgrades you've done since the last purchase or refinance. Step number 8, plan the escrow. Know how much the new escrow needs, and when the old refund shows up, if you can pre-decide to throw that back towards that refund back towards principal balance, it'll do you wonders. Step number 9, set up a post-close habit. If your new payment is $300 lower, consider auto-paying the old amount. Extra principal turns your refinance into a wealth move, not just a comfort move. And then step number 10, put a reminder on your calendar 60 days before your rate lock anniversary next year. Check the market again. If rates have improved more and costs are low, you can rinse and repeat. There's nothing from stopping you. What to avoid so you don't sabotage this? Do not open any lines of credit mid-process in any form or fashion. Do not make any large undocumented deposits. Do not miss any payments, even by a day. Trust me, it does matter. Do not quit your job or change how you get paid without talking to your loan officer first. I've had this happen. Don't do it. Do not ignore a prepayment penalty on an investor loan. Don't forget to compare 5-year costs, not just day 1 of your new payment. Also, watch your emotions. Falling in love with a specific rate number can make you pass on a deal that meets every one of your goals you've already set. Money saved is money saved. Take that win to the bank. This window, it can be open for a while or it can be closed immediately. Rates drift down, headlines spike, pipelines fill up, and then pricing shifts. Be the person who had the docs ready, the plan clear, and locked and secured. If you want my help managing your exact numbers, I'm here. My team and I work this playbook every day across Cherokee, Cobb, North Fulton, across 27 states, and we'll shoot you straight on whether it's time or not. Clear eyes, real data, and better guidance. That's how we keep deals alive when others panic. That's how you use the 2025 to fix the most expensive debt in your life, and that is guaranteed.